Britain discovered early that value travelled faster than armies or ships. Currencies shifted empires long before soldiers marched or cannons fired loudly. London realised mastering exchange meant mastering world behaviour quietly and permanently. Thus began empire built through rates, arbitrage, and meticulously engineered trust. Medieval merchants gathered beside Thames trading foreign coins with whispered precision. Italian bankers introduced accounting techniques enabling Britain calculate value scientifically. London embraced innovation, turning primitive barter into structured financial mathematics confidently. Foreign traders realized London possessed clarity other cities lacked during currency confusion. As commerce expanded, currencies collided, creating profit opportunities through strategic conversion. Britain studied patterns, understanding movement of value across fragmented continental markets. Exchange became science, allowing Britain anticipate political shifts through currency behavior. Information transformed into power, elevating London above rival European trading hubs. Goldsmiths evolved into proto-bankers, controlling flow of foreign coinage locally. Their vaults protected wealth, while their ledgers recorded international financial relationships. Trust concentrated inside goldsmith shops, strengthening British influence within emerging monetary systems. Currency circulation revolved around London, shaping destiny of merchants worldwide. Britain improved exchange methods, establishing networks connecting ports across expanding empire. Colonial currencies varied, but London provided consistent benchmark guiding commercial activity. This benchmark created loyalty, ensuring traders depended on London for valuation. Dependence grew until London became undisputed arbiter of international monetary identity. Insurance markets boosted confidence, enabling merchants conduct transactions across dangerous waters. London guaranteed protection, encouraging trade routes once considered financially hazardous. Confidence increased liquidity, making London central reference for risk assessment globally. Risk pricing allowed Britain steer behaviour of merchants indirectly yet effectively. Lloyd's Coffee House became meeting point for traders, shaping London's financial consciousness. Currency discussions echoed through smoke-filled rooms, influencing decisions continents away. Information traded faster than goods, building foundations for future exchange markets. Knowledge became commodity, ensuring London thrived by aggregating global financial intelligence. As empire expanded, Britain introduced coinage, integrating colonies into unified system. Standardized currency strengthened cohesion, simplifying commerce across vast multicultural territories. Unified value anchored diverse regions, linking fortunes directly to London's decisions. Exchange became instruments aligning colonies with British economic and political priorities. Merchant fleets carried silver, gold, spices, textiles, and currencies from distant lands. London priced every commodity, determining relative value on global commercial stage. Exchange rates reflected British judgment, influencing trade patterns across continents comprehensively. Thus, London shaped world markets through subtle arithmetic rather than overt imperial command. European powers struggled standardizing currencies, lacking cohesion. Britain cultivated strategically. France, Spain, and Austria faced instability due to inconsistent metallic standards. London exploited instability, offering conversion services, prized by British discretion. Foreign reliance expanded, giving Britain increasing authority within continental financial conflicts. Bank of England emerged stabilizing force, reinforcing Britain's growing monetary leadership. Its policies influenced investors, shaping confidence in Britain's management of volatility. Currency convertibility strengthened reputation, making London cornerstone of global financial stability. World trusted British discipline, allowing London dictate acceptable international monetary behaviour. Wars provided Britain opportunity, strength and control through manipulation of exchange rates. Foreign currencies collapsed during conflict, forcing nations seek British financial assistance. Britain evaluated requests determining which nations survived economic destruction or collapsed. Exchange became diplomatic weapon granting Britain leverage even during military neutrality. Foreign merchants adopted sterling for international transactions, bypassing local monetary uncertainty. Sterling became universal language understood across Atlantic, Mediterranean, and Indian Ocean. Dominance emerged not through decree, but through reliability unmatched by competitors. London's clarity made sterling backbone of expanding global commercial architecture. Exchange brokers in London mastered arbitrage, identifying discrepancies across multiple markets. They exploited differences, generating profit, while shaping behavior of international participants. Arbitrage strengthened London, increasing flow of capital across British networks globally. Compounded profits reinforced idea London possessed unmatched superiority within currency exchange. Britain established correspondents in foreign cities, gathering intelligence essential for dominance. These correspondents reported political changes affecting currencies ahead of public knowledge. Information allowed Britain adjust exchange strategies before rivals detected fluctuations. Advantage accumulated, strengthening British algorithm of global financial anticipation. When colonies minted local coins, Britain controlled supply, determining value distribution. Scarcity or abundance manipulated compliance, aligning colonial economies with British priorities. Ripples affected trade, forcing colonies follow London's rhythm of valuation. Currency governance mirrored political governance, reinforcing Britain's macroeconomic authority. International fairs brought merchants together, exposing weakness of fragmented European currencies. Britain showcased efficiency, converting multiple coinages through rapid, disciplined calculation. Merchants trusted British numerical mastery, preferring London's method over local alternatives. Superior precision encouraged widespread adoption of British exchange conventions across Europe. Industrial revolution accelerated movement of goods, increasing importance of exchange centres. Britain became hub, evaluating value of coal, cotton, and manufactured output. Currency markets evolved, responding to wave of industrial globalization seamlessly. London dictated prices, integrating old mercantile world with new industrial capitalism. Railways connected distant towns, increasing velocity of information, influencing exchange behavior. Britain capitalized, establishing telegraph lines, transmitting currency rates instantly worldwide. Speed created advantage, allowing London adjust valuation before rivals reacted. Telegraph transformed exchange into real-time theatre, controlled from British financial headquarters. Foreign governments monitored London's decisions, carefully adjusting policies accordingly. Exchange stability in British markets often determined fate of continental economies. Governments adopted British practices, modernizing currencies, using London as reference. Influence spread quietly, embedding British philosophy into international financial governance. Speculators aligned with Britain manipulated expectations, influencing future value predictions. These predictions guided investors, shaping direction of entire global economies. British expectation became prophecy, affecting decisions taken by ministers worldwide. Exchange markets turned London into oracle, forecasting outcome of geopolitical events. Crises abroad strengthened Britain, nations fled to safety of sterling. Conversions increased demand, reinforcing sterling's dominance across uncertain environments. Global panic ironically concentrated more power inside London's financial districts. Fear made world dependent on Britain's stability, increasing empire's invisible influence. Europe attempted cooperation, establishing stable currency union of resisting British dominance. Differences among nations prevented unity, letting Britain maintain overarching influence. Fragmentation benefited London, allowing continued provision of exchange clarity consistently. Cooperation efforts collapsed, demonstrating resilience of Britain's established monetary architecture. Britain understood early that empires survived not through conquest alone. True dominance required income flowing steadily from distant foreign economies. But open taxation provoked rebellion, threatening stability of expanding British power. Thus, Britain engineered system extracting wealth invisibly, without raising imperial suspicion. Invisible tariffs emerged through subtle manipulation of global trading rules. Nations believed practicing free trade, while Britain modified framework controlling outcomes. Every shipment carried hidden cost benefiting London more than exporting nations. Tariff impact masked beneath prices, demand, insurance, and maritime logistical structure. Merchants worldwide trusted British ports, offering predictable regulations and stable valuation. But predictability masked advantage, calculated into every transaction entering Britain. Foreign traders unknowingly paid extra sustaining British Empire through ordinary commerce. Invisible tariff became silent collector, turning global trade into imperial revenue. Customs officials quietly adjusted classifications, determining duties for foreign imports. Reclassification increased charges, without appearing like overt taxation to outsiders. British merchants exempted subtly, ensuring domestic industry enjoyed massive competitive head starts. Foreign competitors suffered disadvantages, trusting rules designed against their prosperity. Exchange rates influenced flow, increasing Britain's earnings from foreign trading movements. Currency manipulation disguised cost increases, appearing like natural market behavior. Foreign sellers received less for goods, while Britain retained difference silently. Exchange became weapon, transforming financial losses into imperial gains consistently. Shipping insurance priced carefully, according to British assessments of maritime risk. High premiums discouraged rivals, raising cost of transporting goods internationally. British fleets received preferential treatment, reducing operational expenses significantly. Invisible tariff embedded within insurance structures made British shipping dominant. Port fees adjusted invisibly, affecting profitability for merchants from distant nations. Britain calibrated charges, ensuring foreign ships paid slightly more consistently. Difference appeared negligible, but multiplied across thousands of voyages annually. Empire profited steadily, without declaring any formal taxation on newcomers. Navigation rules dictated routes, benefiting British-controlled channels across global waters. Ships detouring longer distances increased costs, supporting British commercial advantage. Higher expenses on foreign voyages acted like invisible taxes continuously. Rules seemed neutral, yet strategically imposed financial pressure upon foreign competitors. Britain controlled lighthouse maintenance, charging ships minimal mandatory service fees. Accumulated fees formed revenue stream funding imperial maritime infrastructure. Foreign vessels required British guidance, paying Empire for navigational assistance. Invisible tariff operated through essential services, disguised as universal safety measures. Dockyard storage costs fluctuated subtly based on cargo origin annually. Britain increased storage time for foreign goods, creating financial disadvantages. British traders received priority, ensuring efficient turnover, strengthening domestic supremacy. Foreign merchants lost profits, indirectly sustaining Empire's invisible taxation network. Colonial products entered Britain, the complex evaluation determining exact taxable category. Ambiguity allowed British officials manipulate classification, benefiting domestic industries consistently. Foreign exporters submitted unwillingly, lacking influence over British customs decisions. Invisible tariff entrenched Empire's control through bureaucratic advantage rather than law. Global traders relied heavily on British warehousing before re-exporting goods internationally. Warehousing fees charged foreign merchants acted like hidden revenue extraction. British middlemen profited automatically without participating in actual production whatsoever. Foreign trade flowed through Britain, paying silent tribute every single time. Weight measurements slightly differed across British ports versus continental alternatives. Small variations ensured foreign goods labelled heavier, increasing duty payments. British goods measured favourably, minimising associated tariff or logistical cost. Measurement disparity created systematic advantage, hidden beneath technical standards. British auditors imposed inspection protocols, extending processing time for foreign shipments. Delay forced merchants pay additional dock charges, increasing cumulative expenses significantly. British traders processed faster, ensuring efficiency, benefiting domestic commerce disproportionately. Invisible tariff thrived through slowdowns, disguised as necessary administrative procedures. Britain influenced global commodity prices through control of major auction houses. Foreign producers received less revenue, while Britain captured difference quietly. Auctions established benchmark rates determining worldwide trade profitability and taxation. Invisible tariff extracted margin through financial architecture instead of traditional fees. Colonial shipping companies, dependent on British licenses, paid recurring operational royalties. Royalties functioned like taxes, channeled directly into imperial coffers discreetly. Licenses essential for legitimacy ensured colonies complied with British fiscal demands. Invisible tariff enforced through administrative necessity, keeping colonial economic destiny. Britain monopolised marine chart production, essential for global navigation safety. Foreign ships purchased charts, reinforcing British revenue at scale annually. Mandatory chart updates ensured continuous flow of payments, supporting imperial finances. Invisible tariff embedded within maritime knowledge distribution remained unquestioned worldwide. Interest rates charged to merchants reflected British dominance over credit distribution. Higher borrowing costs for foreigners increased cost of doing business internationally. British firms borrowed cheaper, enabling them outcompete rivals consistently worldwide. Financial disparity acted as invisible tariff enforcing superiority of British commerce. Shipping schedules controlled by British companies determined global access and availability. Delays strategically created scarcity, forcing rivals accept less profitable arrangements. British traders received priority, maximizing profitability under empire-designed logistics. Invisible tariff monetized time, proving empire profited from global impatience. Freight charges adjusted quietly by British carriers, shaping international cost structures. Foreign exporters paid more per unit, shifting trade balance toward Britain. British exporters enjoyed discounted rates, making domestic products globally competitive. Invisible tariff emerged through logistical pricing rather than explicit taxation. Foreign merchants used British brokers who collected commission on every transaction. Combined commissions formed enormous revenue streams supporting financial institutions. Britain controlled flow, ensuring brokers shaped prices beneficial to empire. Invisible tariff existed through dependence on British commercial intermediaries globally. Foreign legal disputes settled in London courts, requiring expensive representation fees. Legal dominance reinforced Britain's control, turning justice into revenue source. Foreign plaintiffs bore majority costs, while British firms exploited procedural advantages. Invisible tariff absorbed through judicial processes, masked by legal legitimacy. Insurance risks calculated with bias, making foreign voyages appear artificially dangerous. Higher premiums punished rivals, increasing British competitive edge significantly internationally. Insurance companies collected continuous fees from foreign merchant dependents. Invisible tariff operated through risk pricing engineered by British evaluation. Foreign debt issued through London forced nations pay underwriting commissions repeatedly. Commissions flowed directly into British financial houses, strengthening imperial resources. Loan dependency ensured future borrowing aligned with British monetary conditions. Invisible tariff extracted through debt architecture, shaping political behaviour internationally. Neutral shipping agreements written under British supervision created hidden cost obligations. Foreign fleets signed documents, unaware clauses favoured Britain systematically. Fees embedded inside contractual fine print added revenue to empire consistently. Invisible tariff hidden beneath legality proved more effective than overt taxation. British-dominated arbitration courts settled commercial disputes, charging substantial resolution fees. Foreign companies paid heavily, trusting British legal neutrality and global respect. Court fees acted as recurring revenue streams supporting imperial legal apparatus. Invisible tariff disguised as judicial fairness strengthened London's economic command. International exhibitions promoted British technology, encouraging adoption of empire design systems. Systems required British components, creating permanent revenue beyond initial purchase. Foreign industries structured around British standards remained financially tied indefinitely. Invisible tariff charged through technological dependency by progress narrative. Foreign shipping timetables aligned with British tide charts, controlling global movement patterns. Tide prediction accuracy granted Britain indirect control over international schedules. Schedules shaped course cycles, influencing profitability of worldwide maritime networks. Invisible tariff collected through control of natural rhythms translated into commerce. Global merchants required London's acceptance stamp, validating authenticity of goods shipped. Stamp fees, small individually, accumulated massively across global trading cycles. Validation created trust, converting British administration into revenue-generating certification system. Invisible tariff operated through approval rather than imposed financial policy. Foreign gold shipments refined in British facilities charged assaying service fees. Refining bound gold markets to London, making purity certification essential commodity. Fees ensured empire profited from metal movement irrespective of geographic origin. Invisible tariff converted precious metal validation into lucrative imperial income. Colonial rail schemes financed through British loans created structural repayment obligations. Rail freight depended on British-built engines, tracks, and signalling components. Costs locked colonies into perpetual financial commitment, strengthening London economically. Invisible tariff hidden within infrastructure agreements shaped empire's developmental priorities. British ports required foreign vessels purchase harbour permits renewed yearly internationally. Small renewal fees multiplied across thousands, generating continuous maritime revenue. Permits controlled through British-run authorities, legitimised through polished administrative systems. Invisible tariff constructed through licensing overshadowed by necessity for global navigation. International accounting standards emerged, influenced heavily by British financial tradition. Standards determined reporting requirements, creating cost burdens for foreign corporations. British firms adapted easily due to familiarity with underlying conceptual structure. Invisible tariff manifested through compliance effort, benefiting British companies competitively. Foreign markets relied on British shipping registries certifying seaworthiness for global trade. Certification fees strengthened empire's contractual authority across maritime industry. Foreign fleets lacking certification suffered higher insurance, weakening competitiveness significantly. Invisible tariff emerged through bureaucratic necessity, keeping direction of international commerce. Britain controlled telegraph choke points, allowing prioritized transmission for preferred financial clients. Faster delivery created trading advantage, functioning as subsidy for loyal merchants. Foreign clients paid premium, enforcing British dominance within communication infrastructure. Invisible tariff extracted through differential speed, marketed as premium service option. Global bond markets formed around London's credibility, keeping investment patterns worldwide. Foreign governments issued bonds through British bankers, paying origination commissions. Commissions ensured steady profit, while embedding influence in national budgets. Invisible tariff collected through financial intermediation created empire built on trust. Foreign shipbuilders dependent on British steel paid elevated import prices purposefully. Price manipulation disguised as market fluctuation concealed empire's profit margins. British shipbuilders benefited directly, gaining international contracts through competitive pricing. Invisible tariff emerged through control of industrial inputs, driving global trade. Nations adopting sterling-pegged currencies, subject to British monetary decisions indirectly. When Britain adjusted levels, foreign countries absorbed economic consequences involuntarily. Control created pathway, allowing Britain impose economic discipline across world quietly. Invisible tariff materialized through power asymmetry hidden within universal monetary stability. International banks maintained British staff, overseeing compliance, protecting London's financial interests. Staff shaped decision-making, reinforcing institutional alignment with British objectives globally. Foreign entities followed British guidelines, maintaining empire's economic shadow influence. Invisible tariff extracted through governance rather than explicit monetary requirement. After centuries of manipulation, Britain perfected system, taxing world without declaration. Invisible tariff operated within rules, appearing fair while benefiting empire exclusively. If this story revealed how Britain taxed the world in silence, remember, real empires are built through systems, not soldiers. Subscribe for more hidden histories buried beneath global finance, because the next revenue machine is already being engineered.